Recently, I haven't been posting on my channel, and that's because I've been actually doing another channel where I've been doing a lot more stuff on 3D printing because right now that's kind of where my passions lie. And I've also been thinking about where I want to take this channel going forwards. And I think that I kind of want to go back to my roots where I did a lot more stock analysis. So this is the first video where I'm trying to go back to those roots, and today we're going to be analyzing Aritzia. So far, I've only taken a brief look at the company, but I'm going to take you along my journey as to what I can find about this company and whether I think it's a worthwhile investment pursuing in my investment accounts. So stock shot up quite a bit right now. You can see from just pre-pandemic, it was sitting around $25. And recently in the past month or two, it reached all the way to $60. But we're coming back down and it's bounced down to the 200-day moving average. Nonetheless, I think the stock has run up quite a bit, so we'll see if there's any value left still buying at this level. If you guys are curious what's going on here, I'm showing you my entire process in fast forward, how I create this spreadsheet tracking things like revenue numbers and store count and other financial metrics, going back and forth from investor relations pages and news articles into the spreadsheet. Didn't really report their stores here. They said they had 90. So it's pretty hard to figure out their e-commerce revenue because they didn't always break that out, especially in 2021. So I had to back calculate, knowing the e-commerce revenue growth year over year from 2022, that I could get Q3, Q2, and Q1 numbers. And then I got the total e-commerce revenue, which was $425.9 million. And then I had to subtract Q3, Q2, and Q1. So I'm going to try to get as many e-commerce numbers as possible for the rest of the quarters, as well as I can now figure out the retail revenue based on the e-commerce revenue numbers here. One of my favorite tools is Finbox. Here we can see the revenues laid out for the past 10 years. I guess Aritzia doesn't actually have that much history, but I can go back to up to 10 years of worth of data, and I can see the revenues. There's also a nice little chart which shows just the growth of the revenue quarter over quarter. We can see the revenue growth year over year, etc. Every single line has a chart associated with it. So we're just going to pull the revenue numbers from here into our spreadsheet, and yeah, we'll see where things go from there. Surfing through the MD&A, I found a key metric here, which was the average square foot per store. Okay, so I just made a major discovery. If you guys are running a retail store, what is one of the most important metrics that you need? The most important metric, at least one that I can think of, is the revenue per square footage. If you're a retail owner, you want to know how efficient you are at turning each square footage of space into revenue. So if we look at the revenue per square footage, or the net revenue per square footage of Aritzia over the past year, compared to the 4 years prior to that, you can see there's an explosion in net revenue per square foot. Now I only have data for the past 2 years or so for the retail revenue per square footage, and you can see right now that also has been following a similar trend, but not as explosive. And the reason is because e-commerce for Aritzia has really exploded over the past year or two in the pandemic. And for the e-commerce revenue, they don't actually need retail store space. Rather, they do need warehouse space in order to store inventory and ship stuff out from there. But I currently don't have the numbers on how much square footage they have for their warehousing. So in the span of 6 years, they've increased their number of US stores from 18 all the way to 38. And in the past 3 years, the Canadian stores, they haven't been opening anymore. So it looks like they might have saturated the Canadian market right now, and they don't plan to open any more Aritzia stores in Canada because there's probably no other good locations where they've identified a new store could be. And for Aritzia, I think they target mainly a lot of the metropolitan cities where there's a lot of people there, so that they aren't wasting their money on stores in little hick towns. So if you guys have never seen an Aritzia store, I just showed you how one looks like. In these stores, I've been in a few of them just because my wife loves to shop there. They're like no other store out there. Like if you go to your American Eagle or Old Navy or The Gap or just other sort of like regular fashion stores that you'll find in a mall, even I would say Lululemon, which is more on the scale of what Aritzia is. I would say Aritzia's interior design is top notch. They look and feel like a high-end boutique, and if you go into Aritzia store, there's always a lot of people in there. On top of this, people love to shop for different brands. In Aritzia, they have 10 in-house brands, if not more than that. If you go to another store, it's only that one single brand. So I think this gives the female population a good amount of choice when they go into the store. They can shop at the brand that they like or the few brands that they like, and it feels like you're hitting 3 stores in one. Since this is an investing channel and you guys love to make money, well, I have an amazing offer for you guys, which is an affiliate of mine, EQ Bank. Currently, they're offering $150 if you sign up for their Savings Plus account and fulfill these requirements on the screen. It's as easy as that, and I personally do use EQ Bank myself. I currently store my emergency fund in there, and this is just because if anything happens, at least I have a cushion which I can live off of for about a year or so. Links in the description down below. So I'm on the balance sheet here, and the question is, why is the balance sheet so important? Well, the balance sheet, what it allows you to see is just the immediate health of the company, as well as kind of the history of how they manage their assets and liabilities. So looking at Aritzia, this is their cash and cash equivalents. You can see in the most recent quarter that a huge jump in the amount of cash that they have on hand. And that's probably why they issued a normal course issuer bid, because they have a lot of cash on hand which they can use to repurchase the stock, and this is another way management gives back value to shareholders. By removing some shares out there in the open market, they make each share a little bit more valuable because there's fewer of them. Looking at the total current assets, it's a similar trend to the cash and cash equivalents. The only thing that we really add here is inventory, which is a fairly major item on their balance sheet. And usually it's not good to see a large amount of inventory or an increasing amount of inventory on a company's balance sheet. However, for Aritzia, I think I'll give them a break because the fact that they're expanding the number of stores they have, of course they're going to also want to increase their inventory levels to be able to meet market demands. Now, turning over our attention to the current liabilities, these are important because these kind of tell you the short-term debts that the company has to pay. If we look at the total amount of current liabilities, it's only $419 million compared to the current assets of $538 million. So Aritzia definitely has enough cash on hand to be able to cover their debts for the next 12 months. And if we look at their total liabilities, this increases to $936 million. However, a capital lease is not really a liability, or it's not a debt that they owe. This is essentially a lease that they signed for X number of years, and this is the amount remaining that they have on that lease. Currently, one of my favorite statements to look at is actually the cash flow statement, because ultimately this tells you how much cash is coming into the company's bank or leaving the bank. So you can see here the cash from operations is $209 million, which is actually larger than the net income. If we go to the income statement, we can see the net income is only $64.9 million. The reason why the cash from operations is larger than the net income is because certain expenses aren't actually paid with cash. For example, depreciation. They already own certain assets, they're just depreciating them, so they've already paid for them in the past. If we look at the trend from cash from operations, this past quarter that they had, they basically blew every other quarter out of the water. So this is probably a major reason why Aritzia stock spiked after the previous quarter's earning announcements. Hopefully going forwards, I think there might be some risk with Aritzia, because if they don't perform like they did in this previous quarter, we could see the stock falling back down. The other metric we should look at here is cash from investing, and this is just how much money they put into purchasing large equipment or possibly even buying companies out there. Buying companies is more of like a one-off event, but capital expenditures can be fairly consistent, especially if their equipment depreciates and eventually becomes obsolete over time. I tend to ignore cash from financing because whenever they do some major financing activities, these are sort of like one-offs or once every few years or so, and they're not really indicative of how the business operates on a day-to-day manner. So if we take the cash from operations and subtract the cash from investing, we get the levered free cash flow. And ultimately, this is the cash flow that the business generates. Looking here at the levered free cash flow trend, you can see it's like exponential growth up to the left. The company is generating more and more cash, and ultimately, this is what you want as an investor: more cash. So going through their investor presentation, Aritzia is stating that they're planning to open 7 to 8 stores in the United States over the next year. And this is actually fairly major because if we look at the trend of how many stores that they've been opening, it's been around 5 or 6 for the past few years. So they're ramping up the number of stores that they can open in the United States. And this is big because if you look at the population of the USA versus Canada, it's 30 million or 38 million or so to about 330 million people. Basically a 10x in population in the United States. And on top of this, Aritzia has identified 100 places that they could open up a new store today, which fits the criteria for what they are looking for when opening up a new Aritzia store. So management is actually very picky about where they open up stores, unlike other brands like Gap or Old Navy, where they just open up a store wherever there's a mall. Aritzia, they kind of choose one store per city. They choose it in a very strategic location, usually a high traffic area, so they can get as much foot traffic as possible and therefore maximize their revenue per square feet. So the possibility for Aritzia going forwards in the States is essentially growing 4x there. And I'm sure going forwards, the number of possible locations will also increase. Now, when you look at the price, yes, it looks like Aritzia is shooting up astronomically and is kind of going to the moon. However, you also have to look at the price in relation to certain business metrics. So for example, we could look at the price versus the last trailing month sales. If we look over here, we can see that the PS ratio is actually getting a bit more expensive. We're seeing it back in 2020, it was around a 2 or a 2.5, and now we're paying about a 4 or a 5. Looking at the PE ratio though, the price to earnings ratio, we can see in 2021 we hit an astronomical number of 168.8 times. However, it's come back down to about 40.8 times price to earnings ratio versus pre-pandemic we're looking at somewhere around a 20 to 30 price to earnings ratio. So we are paying a little bit more for Aritzia right now. However, I think the growth could possibly be there to support this higher PE ratio. And the reason why I say these higher metrics could be supported is because if you look at the revenue growth here, it's like pretty flat around here at around 10 to 20%. Then we're seeing 121, 74, and 62. We did have some negative growth here, but if we average these two out, like 62 plus 4% divided by 2, we're seeing about a 30% growth. We were only seeing about 20% before. Same here with this quarter versus the previous quarter, negative 43 plus 121, then we get around an 80% growth or so. But on average, we're seeing around 40% growth year on year if we average this year and the past year. So now to answer the big question, am I going to buy Aritzia at these levels right now? Well, I think I'm still a bit on the fence because Aritzia has skyrocketed up, and we've kind of seen what's happened with a lot of stocks that shot up quite quickly. They did come back down. I mean, that's not really a great reason for not buying Aritzia right now. However, that does seem to be the trend, and right now that is a real concern of mine. That the market is seeing the stock as hot right now, and possibly people who got in around here are looking to sell out. So this is more just kind of looking short term when I want to make my move in the stock. I do think that this company does have a long runway to grow because they can open up another 100 stores in the USA. If we do some quick math over here, just give me a second. I would expect them to earn about $690 million per quarter. And this calculation was done based off of the total number of stores, so 68 in Canada, 138 in the States, multiplied by the sum of the 3 net revenue per square foot over the past 3 quarters, divided by 3 to get an average net revenue per square foot per quarter. And then I multiply that all by 6,000 square feet, which is the average square feet per store. So that should give us total revenue in each quarter, roughly around $690 million. If we multiply that by 4, then we get a total net revenue of $2.7 billion in a full year for Aritzia. So this is a future possibility that I can see with Aritzia, how much revenue they pull in. The company is worth $5.228 billion. So if we take a PS ratio, right now they're at 4.26. Multiply that by their total revenue per year, about $2.7 billion. That would give us a price of $11.5 billion, meaning I would double my money in about, let's say it took them about 10 years to open. So I think looking at this metric now, it might not be as appealing to enter into Aritzia at this current point in time. I would wait for the company, at least the share price, to drop a little bit, which gives you a bit more margin of safety. And going forwards, you'll have a better return on investment. Aritzia has run up pretty hot because of the previous quarter. So we'll have to see what happens in the next few quarters to see if they can sustain this kind of growth that they've shown in the past quarter. If they can, then the stock price will probably continue going up. But if they can't, you know it will drop back down. And that's when I'll be looking to buy in. So currently, my conclusion after doing all this research, which I didn't have a conclusion coming into it, I think that Aritzia is a little bit expensive for my taste right now. I actually thought that there was going to be value into buying the stock at this current moment, but looking at the possible growth over the future, as well as the price premium that's already baked into the price of Aritzia stock right now, I don't think it's good value right now to purchase. Also, if you're holding Aritzia stock though, maybe you want to consider selling off a small portion of this position. It's possible that we could still skyrocket up a little bit higher, especially if the next few quarters have amazing results. But if you want to take some cash off the table right now because you made a killing on the stock, then there's no shame in doing that. I'd be interested to hear what other stocks you would like me to research, so let me know in the comments down below, and I'll be sure to take a look at those companies. I want to be looking at a little bit larger companies, not any sort of penny stocks out there. So the minimum market cap that I'm kind of looking at right now is about $2 billion. So what company do you guys want me to look at next? Let me know in the comments down below.